Jim Cramer saying to sell some stocks, raise cash right now. I want to watch a little clip of this. It's about a 1 or 2 minute little portion here and hear what he has to say about selling stocks, what stocks to sell right now. And I'll give my perspective on that in this video. Second video I want to react to and give my opinion on is Cantor Fitzgerald. Eric Johnson says, even if earnings don't go down, the market is overvalued. We'll hear what he has to say. I'll react to that and give my opinion. Last video up here is Tom Lee's right-hand man Mark Newton expects a rally in the treasury market near term. Also hear if he has to say anything about stocks and kind of where they're going and kind of give my opinion on that. Thanks to everybody that's always here. I appreciate each and every one of you. Thank you for everybody subscribe to the channel. We're getting close to 24,000 subscribers. So thank you everybody. We'll probably hit that in the next few days. I appreciate each and every one of you. Also tomorrow's the big day. Patreon squad. I'm posting the stocks I am buying tomorrow. Screenshots as I do every Friday. So if you want access to see the stocks I'm buying every single Friday or selling, I share those every single Friday, and tomorrow's the big day. And also you get to support the channel, so I appreciate y'all as always. Let's get into this.
Look, when the CEO of JP Morgan, the world's largest bank, says there is scary stuff ahead, well, guess what? You take notice. When Jamie Dimon reels them off, Russia, Ukraine, oil, gas, war, migration, trade, China, not to mention the possibility of 6% interest rates. That's what he's talking about because of persistent inflation. You get scared. And the market plunges right on time. Although, fortunately for the bulls, the fear eventually subsided. Dow ultimately finishing up 109 points. S&P advancing 0.53%. That
looks like a skate ramp, huh? Ooh.
That jumping 0.72%. Now, earlier this week, I told you the market would find its footing once stocks came down enough and long-term interest rates started falling. And that's what really happened today, and it's why the averages ultimately turned. That said, I still think it makes sense to do some selling in certain select areas, especially the techs and the fintechs and SPACs with crazy down valuations and no real earnings.
So he just said sell techs, sell fintechs, sell SPACs. Interesting perspective there, okay? Those are obviously a wide range there. When it comes to the techs, I think it's a tough sell. I think that's a tough sell. What are you going to sell? You're going to sell Microsoft. You're going to sell, even though Google has a lot of things going for it, you're really going to sell Google at $90 right now, or are you really going to sell at a Meta with the next several years of runway? It's going to be a $400+ stock. You're really going to sell at a Meta right now? You're going to sell at a Tesla? You know what I mean? You start running through these and it's like, gosh, you could do that, but you're just hoping and you're on hopes and prayers that the market goes down short term. So hopefully you can buy those for cheaper, right? Oh, I sold Tesla at 200 and so I can get it back at 150 or 175. And then you're just playing a trading game. You're playing the, you're playing the game of trying to time the market at that point in time, which we know is a failing strategy. That is something we do know over time. So to me, it just doesn't make a whole heck of a lot of sense, to be quite honest. And then in terms of a lot of people that were in SPACs, like they got out of those if they wanted out of those last year. So that's kind of, I don't know about all that, okay? Next video up here, Cantor Fitzgerald, Eric Johnson. What does he have to say? This guy's flipping all over the place all the time. We'll hear what he has to say now.
Eric Johnson of Cantor Fitzgerald. Stephanie is a CNBC contributor. It's good to see both of you. Eric, I'll go to you first because you're still super negative. And I'm wondering what still prevents you from being positive even incrementally, because you seem to be doubling down every time you come on.
Yeah, there's not a lot to be positive about. We would disagree with this newfound view that the chances of a soft landing, no landing, or the chances of a recession going down, we would disagree with that view completely. I think if you look at all of the coincident indicators, payrolls being one of them and the current strength of the consumer, they're doing great, right? Labor market remains, somewhat tight, but that's not a forward-looking indicator. If you look at the forward-looking indicators and you look at things like the fact that we're at 3.4% unemployment rate, which is by definition the top of the cycle. There's a delayed reaction to Fed hikes to some degree, whether it's 6 months or 2 years. The leading economic indicators negative for 10 months in a row. Consumer excess savings, they still have, but it's going down by the day and will likely be zero by the middle of the year. Credit usage is surging. All of that, I can go on. All of the leading indicators suggest that the economy is going to decline throughout this year and will likely go into some sort of recession, but for sure will be in decline. And if you look at prior to all prior recessions, People were calling for soft landing, and payrolls were very strong. And we see that changing. And what makes our conviction so high is that valuations, and this was touched on earlier, valuations right now are excessive. The equity risk premium is 1.5%. To put that in perspective, the average over the last 10 and 20 years is 3.2%. If we were to go to 3.2%, that would be 3,100 in the S&P 500. So valuations are excessive, and earnings estimates are still too high.
All right.
So, okay, I'll push back against that, okay? So he gives the bear case there. Let me give the bull case, because we know, Lord, I can do that, okay? I can give them both ways. I can give you that bear case and make you want to sell everything. I can give you that bull case and make you want to go all in margin, okay? I could do it either way. So let me take the bullish side here, okay? So bullish side, he just mentioned 10 months straight of, economic indicators getting worse, right? I can make a very strong argument that we're actually in a bottoming phase right now over this next few months, and things will get better from there, right? You could bring up that as a point. He talks about valuations here, right? And he speaks about the market's overvalued. And I could say, well, if you look at large caps, you can make an argument there. If you look at mids and smalls, no. If you look at the past 25 years in the market, mids and smalls, other than last year, have been trading about the cheapest they ever have in the past 25 years or so, right? Inflationary pressures are obviously becoming less. Yes, inflation is still relatively high, right, from a normal time period, but it's nothing like we had last year. Commodities are all coming down substantially. That will eventually hit the reality, okay, hit the real world in regards to that, right? And if you look at, obviously, states are spending money, obviously, very aggressively, and they can because the federal government's backing them. A lot of federal spending bills coming, right? Infrastructure plans coming, right? You look at all those factors. Social Security, huge bump here in 2023 for obviously the elderly folks out there. So, I mean, you can look at it from many different angles like that, and there's definitely a possibility you could have many different items even be deflationary, actually, in 2023. So there's always two ways to look at it, right? And I'm kind of, as far as my opinion right now, I'm something in between. I see both cases for bull and bear. I'm something a little more in between right now, and kind of my beliefs on the economy, things like that. I'm not super excited about 2023. But I do believe, actually, many of the biggest companies in the world are going to see their earnings actually improve as 2023 goes along, and actually not decline. It will become a better and better story as the year goes along, and I think the market's kind of, front-loading that a little bit.
You can debate with the best of them, so have at it, because Eric's view is so different from yours, it's striking.
Well, yeah, so I agree that payrolls are a lagging indicator, but initial claims are a leading indicator. And you are now, again, another week of sub 200,000 in initial claims. And you're down on the 4-week moving average about 6% year over year. So labor market's still very tight. Wages are still strong. Even though they're coming down a little bit, they're still strong. So real incomes are actually going up for the consumer. And I would just simply point out that the consumer, it's not all gloom and doom. I went back and I looked at Walmart, Kroger, and Dollar General on a 3-year stack basis for comps. That is an indication of demand. And Walmart saw a 24% increase on a 3-year stack basis to comps. Kroger at 22% and Dollar General of 17%. This is just an indication.
Okay, let me push back against her points there now, okay, because she makes an argument for these guys in their comps. Well, if we think about Walmart and Dollar General, those are like, the lowest tier there. So if they're doing, let's say higher sales volumes, doesn't necessarily mean people are in a good place. It could actually mean people are in a bad place, so they have to shop at Walmart, they have to shop at Dollar General and places like that, right? Maybe some Target customers trade down to Walmart in a tough period. So I don't know about that, okay? I don't think she brought up the strongest points to make there, in my personal opinion, okay?
Companies are telling us that they're seeing, and so the consumer remains strong. Resilient is the word that I would use.
In terms of the consumer, if you look at their consumer confidence last year, and this kind of goes back to, against that bear thesis, right? It was the worst we've pretty much ever seen in history in terms of the Michigan Consumer Confidence Index. It was the worst we've pretty much ever seen in 2022, right? Can't get any worse than that, like literally. So the good news is consumer confidence has been ticking up for many, many months now. And at some point in time, that does matter.
And then also, I would look at the ISM services and the composite numbers. The Chicago Federal National Activity Index came out. It's the first positive number that came out in 4 months. And so there is underlying momentum. And yeah, this is also leading to stubborn, sticky inflation. And it's not going to change the Fed's path. But I kind of think the economy has so much more momentum than it's getting credit for. And I think that's going to translate into better earnings, not great earnings, Scott, you know that, but not a collapse by any means, because I do think overall everyone's talking about the expensive market, but I think that the E is wrong. I think the E is going to be better than people suggest.
I 100% agree with her in terms of many of the biggest companies out there, and even a lot of the smaller companies I own. I mean, I'm looking at their 2023, and I expect their not only revenues to be much better than 2022, margins to improve considerably, cash flow to improve considerably, and their net income and the earnings per share. So everything across the board, and that's even with many of my small cap companies I own, right? Never mind many of my large companies like the Amazons and Metas, their profitability is going to take off as the year ticks on, essentially. But even a lot of my smaller guys, they're going to see even a bigger uptick when it comes to that.
In other words, Eric, you're too negative. You're not focusing on any of the positives. You just assume that the Fed has done a lot, and it's ultimately going to have a toll on the economy and the consumer who's going to run out of money, and delinquencies are going to pick up even more than they already have on credit cards, and this whole thing is going to come eventually to an end.
So what's great about our view is that even if earnings don't go down at all, the market is still overvalued at this price. So if we have this great perfect landing, we have growth, inflation comes down, Fed stops hiking, stocks are still too expensive and will likely move lower. Now, here's what I would tell you around earnings. On October 1st, of last year, the estimate for the next 12 months was $235. We've now had 2.5% GDP in the fourth quarter. We're looking like 2.5% in the first quarter. And the earnings estimates have gone down from 235 to 220. That's in a 2.5% GDP growth environment.
Yeah, so once again, he brought out the point again that the market's overvalued. And I say large caps definitely trading rich still. Mid caps, small caps not trading rich whatsoever. So there's a big divergence there between kind of, reality and maybe his beliefs there. Fundstrat's Mark Newton, what does he expect here?
1,000 or 4,000? What makes more sense to you?
Well, I'm a bull, Scott. Look, I don't think we've seen sufficient deterioration to think that this bull market rally has run its course. We pull back exactly to where we need to really hold the uptrend from October. It's about a 50% exact retracement in both price and time to the move up from late December. This whole narrative shift over the last couple of weeks with the stronger economic data has caused sentiment to get worse and worse and worse. And so now we're actually approaching pretty bearish near-term sentiment levels. And look what's just happened in the last 24 hours. Now we see Treasury yields starting to roll over. And that is specifically what investors need to be watching to think that this market likely can extend. The market meaning both the bond market, but also the stock market, in my view.
Wait, so you think rates may have topped for at least the near term again?
There's certainly enough evidence when you look at just the trend over the last few weeks and getting down. We're at, 387 today. If we break earlier week lows 384, then that's going to jumpstart a pretty big Treasury rally over the next couple months. And I think equities get up towards 4,200. Above that, can get up towards last August highs, 43.25 or so. So, I think, look, we have weekly momentum clearly in place. Breadth is actually in very good shape. Now we're combining that with skepticism, with pessimism. Everybody thinks, the central bankers are so hawkish, we have to continue to hike. Well, rates might not do exactly what they're saying. We're actually seeing evidence that they can peak out here and roll over. So if that happens, equity markets are going to rally.
You want to take a stab at this, Mike?
By the way, treasuries, if you're wondering why that even matters in relation to kind of the stock market and whatnot, is think of it as, the best way I could put it is think about it as everything's grabbing for your money when it comes to investing, right? And so you have all these potentials. You could put your money in a savings account. You could put your money in a CD account. You could put your money in a treasury bill. You could put your money in the stock market. You could put your money in individual stocks, right? You could put your money in bonds. You could buy real estate with that money, right? There's so many, you could buy crypto with that money. There's so many different avenues for investing, right? You could buy gold. You could buy silver. You could put it in commodities, whatever, okay? So for the stock market, it hasn't had much competition until recently. And recently, obviously, treasuries are significant competition because you can get great yields there. Even savings accounts for some banks, not all of them, but some are starting to be pretty darn competitive. CD accounts now, many of them are starting to yield, for some of the higher yielding ones, 4.5%, and might go up to 5% or so here soon. And so it used to be where it was like, what are you going to put your money in a savings account, a CD, a treasury, and get nothing? No, let me invest in the stock market, right? So there is absolutely more competition for the stock market now in terms of the money out there than there was previously. And that does matter. That does matter. There's no doubt about it. And some people, and that's why a lot of people are just kind of holding on to cash right now and sticking their money in treasury bills or just sticking their money in CD accounts or whatever, because they're kind of like, I don't really want to buy right now because I can get this 4%, 5% yield or whatever, right? And it's seen as no risk. Versus a stock market, which, if you're in the S&P 500 over time, usually you can get an 8% return, right? Obviously, if you're in individual stocks and those individual stocks do very, very well, you can obviously, destroy that sort of return. But some people are looking at it and they're like, I don't want to take risk right now. I'm uncertain about the environment. I'm uncertain what's going to happen in the market. I don't have a lot of confidence, so I'll just make my 4% in a treasury or in a CD right now. That's how a lot of people look at it.
Internals, Brett, that look good to you like it does to Mark?
In general, it has looked good. So that's kind of built up this base of, benefit of the doubt that you might be able to give the market at these levels. Valuation's not compelling, but it's also not going to be fatal to further upside. Keep pointing out that outside of the very largest stocks, valuation's really not that challenging. And I also don't think that it's the level of rates that corresponds to a particular index level. I keep pointing this out. We were at 4,000 the S&P in May of last year, and we were at 3% on the 10-year. So it's the speed of the move. It's what it means about whether we're chasing inflation or not. Real rates are now actually, pretty generous at this point. Arguably, bonds become a good buy. Maybe that means that yields can hover or come in a little bit.
And Mark, you mentioned this sentiment shift. I think with the way that you characterized what we've seen over the last couple of weeks. It's been justified, hasn't it, though? You got that really strong employment report, and that made everybody sort of stand up and say, uh-oh. Yeah, you know what that means? More hikes and higher for longer.
Well, that's the entire point, Scott, is that when everybody leans in a certain direction, you generally don't want to be there for very long. Look, you saw the equity put-to-call ratio hit the highest levels of the year yesterday at 0.80. AII sentiment is now back to bullish. The CFTC data with large specs are still very negative, minus 200,000 short S&P contracts. And you actually see CFTC data also being quite negative for treasuries also. The lowest levels we've seen, the highest levels we've seen in shorts for almost 4 years. So that's interesting to me. It means that people clearly are all betting that rates are going to go higher and that stocks should go lower. I like to take the other side of that, So in the words of Trey Anastasio and Tom Marshall, everything's right, so just hold tight. I think we move higher. And in general, weekly momentum and breadth support my view. I think we're going to be fine. And really any further pullback that causes sentiment to get even more bearish, that's going to create a really good opportunity. I don't think S&P gets below 3,900. Today's move looks important, but it's really 4060 that we need to get above. Above that, we can really start to accelerate higher. So, I like technology. The move in semis today continues to be very, very good. The majority of your polls suggested people don't want to buy NVIDIA. Well, the SOX is showing tremendous strength. It's the best part of technology. People need to be in semiconductors, and increasingly they're going to want to be in counter-trend pullbacks for groups like energy and also healthcare. They're going to start to look a lot better in the months to come.
So it's interesting. He's saying buy tech. Jim Cramer here was saying sell tech, right? And, in terms of that, NVIDIA, obviously strong day today. I think it ended the day up 14% or so, right? I think sometimes people are just going back to kind of thinking about these talks and where they're going long term, right? Especially with some of these great companies like an NVIDIA is, or Tesla's, many of these companies, right? And it's like you can wait around and hope NVIDIA goes back down, right, to $100-something. You can wait around and hope Tesla goes back under 150 or something like that, right? Or you can get in them, start positioning yourself, right? If it goes lower, take advantage and buy more shares, throw them in the filing cabinet, right? If it goes lower, take advantage of that as long as you have more income than expenses, right? Or you can wait and hope that maybe it goes down. I can tell you, whenever you're just hoping something happens in the stock market, it's not a good place to be. I've been there many times over the past 15 years. It's never a good place to be. You've got to be able to see an opportunity, pounce on an opportunity. If you get another opportunity, great, take advantage of that one as well. You can get several opportunities in the market. But to hope, to wait around and I think it might go lower, it's not usually the best strategy. But unfortunately, that's a strategy a lot of people are employing right now, which creates obviously, it creates issues for them as the market obviously goes up more and more, which kind of gets into why so many people want the market to go down right now, because they're not invested enough. And also a lot of people are short, and the shorts have just been getting absolutely obliterated for the last many months now at this point in time, since the market bottomed October, November. Since then it's been the shorts have just been on the wrong side of this the whole way, right? Playing the put options and whatnot. So anyways, appreciate you guys joining me. As always, much love. 24,000 subscribers on the way. Appreciate each and every one of you for being here as always. And make sure you join us in Patreon to see what stocks I'm buying tomorrow and to support the channel. Appreciate y'all. That'll be pinned comment, and have a great day.